Well, crop insurance is an important tool for farmers, but it can be complex, and it can also lead to significant legal issues involving policies and also claims. Well, Roger McEowen with the Washburn School of Law joins us now with further perspective on the matter. And Roger, as always, thanks for your time here today. First of all, can you give us just a brief background on Federal Crop Insurance Corporation and also how it works?
Sure, Janet. Good to be with you today. The FCIC is a wholly owned government corporation that the USDA's risk management agency actually manages. So the FCIC is the entity that manages the federal crop insurance program, and it provides reinsurance for crop insurance policies that are approved under the Federal Crop Insurance Act. That act itself is managed by a board of directors subject to the direction of the USDA secretary. And then the board in turn delegates to the RMA administrator, which manages the FCIC, certain authorities and powers. And so it's the board that actually approves any new policy or an insurance plan or any modification to an existing plan that the board would establish. And so what you have is a very complex system where a private party will design a policy. It'll then submit it to the board in what's called a 508H submission. And the board will approve that if it determines that the crop insurance policy will adequately protect the interest of producers.
Now, Roger, I understand there's a recent case that illustrates some of the main challenges of crop insurance. Can you give us a brief overview?
There is. There was a recent case that came out of Minnesota just a few weeks ago, and it was a set of facts where you did have a private company along with the North Harvest Bean Growers Association and the USA Dry Pea and Lentil Council, and they made a policy proposal submission to the board in 2011, and they were proposing a revenue assurance policy to protect the pulse crop farmers against a drop in price of crops measured by the difference in the spring price and the fall harvest price. Well, when the policy was being reviewed, it was noted that the projected price would convert the policy into a yield protection policy, even though farmers would have paid for revenue protection. And it was noted that that would be unfair to farmers. So the private company replied that, well, if the policy would have the harvest price set by the FCIC whenever a harvest price couldn't be calculated, and that revenue protection would still be available, they're good with it. Policy gets approved. RMA is permitted to make technical changes to it. Long story short, what happens is they put a default provision in that said that the harvest price can't be calculated according to an AMS method. Then the harvest price is going to be the projected price. What happens is you get a bunch of dry kidney bean farmers, dark red kidney bean farmers in Minnesota that bought the policy thinking that they had revenue protection measured by the difference in the spring and fall prices. Well, prices dropped in 2015. There wasn't enough data to establish a harvest price. So USDA, FCIC, RMA set the harvest price equal to the spring projected price and basically converted the policy to revenue coverage and wiped out any payment under the policy. Then they end up in court on that. Court says, no. Ultimately, sent it back to the agency to redo this to protect farmers.
All right, Roger. And do you have any quick takeaway from this case?
Well, crop insurance is really important to many farmers, but it's very complex. It's very confusing because you've got all these sub-agencies involved in USDA overseeing this. But there is a rule that says that under the Administrative Procedures Act, that has to be complied with whenever an approval of a policy is being made or whenever changes are being made. So even that process is very complex.
All right, Roger, as always, thanks for your insight today. Roger McEowen, he's with the Washburn School of Law. Go online to washburnlaw.edu/WALTR for more information.